Welcome back to part 2 of the video. We talked about the amount of money that was being presented to foreign central banks through the FIMA, which is basically a repo facility for international central banks. Now, in that video, I did say that we were going to do a two-part video and that I was going to explain why I believe that stocks are not going to go sky high. And rather than dealing with just the institutional side of things, which I, as I said, already dealt with in the last video, I'm going to go into some more detail regarding why the residential investors are going to get hammered basically in this coming few months. Now, so this video is why I think stocks are not going to go sky high. Now, I want to cover some ground on this. I'm going to be looking at just very basically more attributes of FIMA, the 3.7 trillion that the Fed has made available. I also want to look at such things as investment concentration, go over why cash is king, look at buybacks and volume, and I also want to look into more depth why, to some depth anyway, why negative rates won't boost the market. Now, let's first of all look at investment concentration. I want you to look at this article, Why Assets Will Crash by Charles Hugh Smith of Two Minds blog. And then he makes some very salient points that are very much along the lines of what I've been thinking. And he basically, in this graphic here, you can see that 10% of the US population owns 84% of all stocks held by households. Now, this was courtesy of our Edward N. Wolf Survey of Consumer Finance's Deutsche Bank research. So we can see that there's quite an asset concentration. Now, why is this important? Well, it's because you have what's called an investment pool of ready buyers that basically have got quite a bit of money to spend when asset values are going up. Now, as you've seen from the chart, basically what this article says, the top 10% owns 84% of all stocks. But here's the kicker. Over 90% of all business equity and over 80% of non-home real estate, and the concentration of ownership of assets such as vintage autos, collectibles, art, pleasure, craft, etc., all these goodies that people tend to buy when they're awash with cash. Now, what it goes on to say, the more expensive the asset, the greater the concentration of ownership. Top 5%, roughly 2/3 of all the wealth. Top 1% own even more, 40%, etc., etc. Now, when we go down to the bottom of this article, what it does say is share price is set on margins and assets like houses are illiquid. Then we can anticipate all the markets for assets solely by the wealthy, owned solely by the wealthy, to go bidless. Well, why is this? Because basically what happens is as the wealth pool goes down, then the 10%, top 10% pull back and say, I don't like this market, I'm not going to invest. And what happens is it becomes a downward spiral and the amount of investors in that 10% rapidly decrease. And basically we have massive asset price deflation. And this is what happened in the so-called Great Recession, is that there was no bids, not on anything. You only had to go to foreclosure auctions and there was houses at 10% of what they are now. So if you think this can't happen, of course it can happen. Now, what we also have to remember is that what I've tried to explain there is that just because some people are feeling the wealth effect of the stock market going up doesn't mean to say that that wealth is going to last. And if, in terms of the thought of that wealth, and when that wealth starts to eviscerate into the money into heaven, money goes to money heaven, then basically the market has got no support of the market. Why am I saying there's no support in the market? Because later on we're going to look at what effect the institutions are having in this market as far as residential investors are going. Now let's look at cash as king. Now from EPFR fund flow analysis, basically there was an article that said buybacks are back, stocks soar even as equity outflows hit 2-month high. So basically there's a contradiction that's going on here. You've got stocks hitting all-time highs, especially in the last quarter of this year, and then you have equity flowing out into bonds, etc. So let's have a look at this. If you don't believe me that there's a massive outflow of cash, of stocks, equity into cash, let's look at these following facts. Basically, in the first week of May, up to the first week of May, between the end of April, first week of May, there was 53.5 billion went into money markets. And what this did is this increased over a 14-week period. So this is a very short period of time. Cash went up by 1.2 trillion extra in the system. So it's now sitting at 4.8 trillion. It was 3.6 trillion. So we've had a 30% increase in cash in the space of 14 weeks. Now, if that's not investors, institutional investors hitting the panic buttons and going for cash, I don't know what is. So if we actually have a look at this chart, you can see the vertical line in this first quarter of 2020 where the cash has just gone absolutely vertically. Now, this is institutions parking their money in bonds and parking their money in cash because they're scared. And I'm going to explain later on what institutional investors are actually doing. So let's have a look. I mean, here's another example of the fund. The research again is from EPFR. As we can see from this, from the S&P versus cumulative US equity fund flows, there's been close to a 300 billion gap. 300 billion gap between what the equity fund flows out has been and the S&P rising. So we see fund flows out and we see S&P rising. Doesn't make much sense, does it? You'd think funds out, equity down. But a lot of this has got to do with residential investing. Now, what is the conundrum that's going on effectively? I mean, basically, the market, the 30% gain in the market from its lows, a lot of it's been due to buyback activity, and especially in the FAAMG, the Facebook, Amazon, Apple, Microsoft, and Google. And we can see from this graphic that there's been an exponential rise. Look, it's vertical again in this quarter of 2020. And why is this important? Well, let's have a look at this graphic. This graphic basically is saying that those 5 stocks have outperformed the market. Look, 10% up, whereas the other 495 companies making up the S&P 500 down 13%. So you might say, well, the market's going up, and Apple and Amazon and etc. doing buybacks. They're obviously thinking that things are healthy. Well, not necessarily. The market's going up because look at this thing here. It's called volume. If you actually look, you can see the massive amount of volume that occurred between February and March. And then we have a very low amount of volume where these higher prices are coming in. Now, volume is an often misunderstood measurement of what's going on in the stock market. Basically, a small amount of volume does not necessarily negate or indicate a trend. But when you find a major move and there's a lot of volume, basically both residential and institutional, then you've got a trend. But at the moment, no, there's no trend in these side of things, and there's going to be blood on the streets basically as far as individual investors are concerned because they're bucking the trend. If you look at that volume, you can see that there's a key element missing in the market, and that's institutional investors. Now, so the real picture is that investors are sitting, the institutions are sitting on piles of cash. Many people are saying, oh, they've been caught out by average Joe investor. Well, let me tell you a fact, having sat in and having been on the institutional side of investing. Investors, professional investors, hedge funds, money market managers look at the long term. They look at the survivability of companies. They look on the ability of the company to pay their debts. And these fund managers can see that this crisis that we're going through is going to smash earnings of companies. Some companies are so heavily indebted they're not going to be able to pay their debts. These institutions know that. They're not prepared to go and risk in the market at the moment. They want to see how everything pans out, especially when these numbers of and the economy starts to get back to some form of, I don't think it'll ever go back to normality, but some form of equalizing the terrible calamity that's happening in world markets, because that's what it is. Whether it's an overreaction or not, I don't know. And in some ways, investors don't care, because many private investors are using this as buying opportunities, but they will get hammered. So if we actually look at this, I mean, this chart, going back to this chart, 10% up with buybacks, 13% down on the normal side of things, doesn't spell anything very good. Now, you might ask yourself, well, you know, there's a lot of money being pumped into this market. You know, the government is putting 3.7 trillion in, and it's a Fed put, and you're really very, very stupid to bet against the Fed. Well, yes and no, because as I mentioned before in FIMA, what's happening is this 3.7 trillion is actually going in the back of the balance sheet of of the Fed. Now, and to reiterate this point, let me go into this article that was in Bloomberg on May the 15th. And it's the heading says, "Pandemic bills are so big that only money printing can pay them." And this was done by Ben Holland, Liz McCormack and John Ainger. Now let me just go into this later on in the article. Very important passage. And this basically highlights what I've been saying. In the US, the Federal Reserve is set to buy 3.5 trillion of bonds this year, according to Bloomberg Economics estimates. Most of that will be treasuries, covering the best part of a fiscal shortfall, forecast to reach at least 3.7 trillion. Now here's the kicker. Nobody knows when the debt will be offloaded from the public balance sheet into the hands of private investors, if it ever is. So if you think that this money's finding its way into the stock market in an instant, you've got another thing coming. This money has found its way into the Fed balance sheet to liquefy central banks, to make sure the bond market doesn't collapse, and we have financial Armageddon much worse than Lehman Brothers ever was. I mean, it would be basically like driving along in a car with the front view in front of you of absolute financial catastrophe, and looking in the rear view mirror, which is much smaller, showing what the Lehman crisis was like. So the government is absolutely in no intent on rescuing this stock market. It's making sure that the bond market stays liquid and the US dollar remains their foreign reserve currency. So that's one side of things. So not only do we have cash, massive amounts of cash being hoarded, because companies aren't too comfortable with being bare cash. Look at Boeing, for example. 100 billion in buybacks, and then there was rumours, etc., that they were going to be looking for 60 billion in rescue. Well, if they hadn't spent the money in buybacks and it cashed up, then they wouldn't need to be in the position. And this is the same with many companies who've got an eye on their balance sheets. For example, look at JCPenney's, recently gone into Chapter 11 bankruptcy, over 3.7 billion debt. Well, why? Because JCPenney's was closed because of this crisis, this virus crisis. No income, no ability to pay the debts. Chapter 11 bankruptcy. Will it recover? I don't know. But this just illustrates the fact. Now, if we actually go and look again, and this is another side of things I hear in the market, and a lot of commentators have actually said that with negative rates coming, there's nowhere else to go but the stock market. The market's chasing yields. Yes, the market always chases yields, but it doesn't. Well, the market nearly always chases yields, but there are certain conditions when the market takes a breath and decides, well, what's happening? What's happening to my money? What's happening to our investors' money? And I'll go over that in a minute or two as well from personal experience. So, as I say, negative rates won't save the market. And why do I say this? Let's look at this FT article. And it says, German savers shrug off negative interest rate fears. Cautious households risk paying as wealth stashed in cash and current accounts hits 1.8 trillion euros. Now, negative interest rates have had little impact on the ultra-conservative savings behaviour of Germans, whose holdings in cash and current account deposits rose 8.5% last year to a record 1.8 trillion. Now, further on down the article, it basically goes to say now that last year negative interest rates cost German savers 27 billion in real terms after adjusting for inflation, according to calculation by DZ Bank. Now, why is this significant? Well, let's look at the numbers again. 1.8 trillion is 1,800 trillion euros in cash. 27 billion is a minuscule amount of penalty to pay to keep 1.8 trillion, in inverted commas, safe. So what am I talking about? Well, here's the thing. And in the mind of an investor, if you stand on one side to lose 10%, 15% over a year of your stock investment, and you have to pay 0.5% to keep your money safe, whether it's in government bonds or certificates of deposit, etc., you will opt for the least painful option. The least painful option potentially is to do nothing and take a 0.5% hit. Now, why do I say this is the case? Because I have clients, and real life clients, and many of my clients sit back and say, well, this market is just too dangerous, and I'd rather go into bonds or take a lesser rate and wait and see what happens. So in real life experience, my cautious investors, my cautious clients would rather, in the real world, park their money where they lose money. I know it sounds crazy, but that's the situation they face. So, you put this into the microcosm of investors and you'll find it's the same thing. So let's look at it from institutional funds. Institutional investors have exited the market. They are not buying. Why are they not buying? Because of the reasons I said. They expect this market to go down further. Now, the residential investors, in other words, the grannies, as I call them, are basically looking to buy the dips, and they're buying it on the dips thinking that this market's going up because of the buybacks that I originally said. Well, nothing could be further than truth, because if you're long and the big investors start coming in and pile in sales, I mean, look at Warren Buffett. He's now sold major stakes in the airlines. He's sold major stakes in his banks. It's recent news. He's reversing quite a lot of his positions. Well, what's he doing? Some people say, well, he's getting to the threshold where he'd have major controlling interests. I don't buy that, because he's reduced his holdings quite significantly. He's sitting in a pile of cash, and he's got a lot more cash. There are people who are just cashing up. Now, so if you're cashing up or you're buying bonds, you're basically saying no to the market. So it's always the same. It happened the same with what happened in 2008, where a lot of private investors really got skinned alive, basically, when the institutional market just dried up with liquidity problems. Now, we are facing in the market at the moment, I think it was Druckenmiller mentioned that we have gone from illiquidity. We've basically gone to a market of illiquidity, and when these dollars get bid on the money market funds and on the repo side, we're going to have dollar shortages again, which is going to put up the price of dollars. So we're going to have the whole fiasco, basically, of spiking and potentially in interest rates, etc. And that means that there's absolutely no incentive for the Fed to make dollars available to the public. They're going to make sure that everything on the bond market, on the liquidity market, is basically okay. Now, that also means that a lot of companies that are heavily in debt are going to go belly up, and the Fed will not be there to rescue them. And as those companies go belly up, that's it, game over. So be very cautious. I believe that this market's still going down for the reasons I've said. The pool of investors is declining. The cash is not going to hit the market. Cash is king. The volume is not there to indicate that this has turned. And there's insufficient motivation on behalf of institutions to really pile into this market. And also, we have a very strong resistance, technical resistance between 24.4 and 24.7. That has to break on the Dow very significantly, and the 3,000 level in the S&P from a technical trading point of view, to actually say, well, this is going up, and it's going up big time. So that's my reasons, and I look forward to seeing you in the next video, and bye for now.